okay, after the big falls of last year, we've seen a resurgence in Bitcoin, up by 21%. We just saw there in US dollars, Ethereum up by 6%. So you're now sitting there and saying, because you believe there is still a future for these assets, that there is also, sort of managed investment schemes that should be created to allow people to break in and have this exposure.
Yeah, I mean, I think BlackRock, by launching that Bitcoin ETF, have basically said they're legitimizing the asset class, the biggest asset manager in the world, Fidelity doing the same. So this thing's coming whether you like it or not. What we've been doing is running a sophisticated investor managed fund for a year, but ASIC have given us, with a series of conditions, the ability to open that up to retail investors as well, which I think is going to give retail investors protection against the terrible things that happened last year.
And what sort of conditions have they placed upon you to be able to do this?
Reasonable ones about the amount of regulatory capital we have, insurance and compliance with all of their other increasing disclosure requirements, which you quite obviously should have, given that these assets are a really, really nascent investment class, and there's all sorts of problems to do with custody and a whole series of other things. I mean, I've been subject to all sorts of hacks and frauds over the last 12 months, luckily been able to a large extent, dodge the full extent of them. But it doesn't mean the fact that somebody who's been in business for 40 years still doesn't find yourself susceptible.
So I was going to ask you about that, because that is one of the vulnerabilities, I guess, is you do see significant frauds and hacks. Everybody thought that the blockchain was impregnable. It turns out it's not. And so therefore, does that add risk to any crypto investor these days?
I think so. I mean, I think you've shaken it out, and I think the people who've lasted obviously are doing better as a consequence of that, because it washed out a whole lot of bad actors. But I've been surprised by the number of places I've got myself with my fingers jammed in the door in the very short time I've been in the business. So it really is a buyer beware market. I hope that after the couple of years in the business, I've got some protections and some good systems in place, but I certainly would never say to anybody this is risk-free. And, in fairness, Ross, with bonds doing 4 or 5% at the moment, risk-free doesn't look too bad.
No, that's probably right. So that's a good idea, and especially if interest rates eventually do start to come down. One other aspect of this is also liquidity, because quite clearly, if you get a Terra Luna situation happen, currencies are frozen. That causes problems of liquidity. Same sort of thing, even when you had Bankman-Fried and FTX and all of those assets frozen up. Is that an issue that would concern regulators as it would an operator such as yourself in creating a managed investment schemes?
Absolutely. And you've got to be sure that you're on the right exchanges with the right coins. Now, there's always going to be problems about markets freezing. So again, I don't want to say it's risk-free, but we do feel like you want to be in the more liquid coins as part of this. Now, we've ended up owning other things, which is, investment trusts at significant discounts and bonds at significant discounts as part of this. Now, these both are real businesses and they have liquidity, but they're certainly very volatile. But our offer has always been to try and reduce the volatility, forsaking some of the upside, just to get a more sensible balance between upside and protection.
But the difficulty, and because you can mark this to market, you can see what the price of Bitcoin is, Ethereum is, what those bonds might be. The difficulty always is to work out whether your managed investment scheme actually trades at the market price, the asset value, or whether it trades below. In your case, how will you work that out?
We'll have the existing NTA, and then we'll have windows for redemption so that people can get out, and so they know that this thing, maybe with a 12-month delay or a 6-month delay, they'll be able to get NAV and get out. I don't think that there's any other way to solve this problem at the moment, Ross. You can't give people daily liquidity in this stuff. It's a bit hard, but nor can you be in a situation where people find this is another roach motel where they can check in, but they can't check out.
I tell you, it is fascinating. Does it exercise your brain? I mean, you've been in the investment games for a long time, and I know this exercises your mind a lot, but as you're trying to work through every one of the obstacles in front of you, you don't find this insurmountable?
No, I don't. I think the truth is I watch my kids on social media and realise that they've got really important digital assets, which are their online profiles, that at the moment they're subject to just getting removed at any stage that anybody can do it. And suddenly they've spent 12 years building a Substack profile or something like that, and Substack can just take it away from them. I think a return to something where you actually own your assets properly and your digital accounts properly, rather than have to live at, the grace and favor of these big internet companies, is going to be a better world for people.
I'll tell you what, it's always great to have a chat. You give me great insight. Mark Carnegie, good to have you on the program. Many thanks for your time.
Thank you very much, Ross.